The last 2 days of trading have been very unusual. Volumes are down across the board, and of course, the range is getting tighter. This is all ahead of the biggest monthly news that comes out of the US, the inflation figures. And we've got JP Morgan's game plan today to discuss, along with our bearish and bullish case thoughts, depending on how this number clears. We'll also be taking a look at the data coming out about some of the tech sectors around the world. And it might not be the one that you're thinking about, but I'll tell you this thing, it is very scary what happens usually over the next 12 months when we get reads like this. Let's take a look at stocks, commodities, and cryptos right now. Well, welcome back everybody to the Daily Show where we talk about markets around the world. Today we'll be discussing central bank liquidity along with our thoughts on the news, macro, lead indicators, and of course, the hottest charts with the key levels. If it's your first time here, welcome to the community. Subscribe, smash that like button. I'm sure you're going to find value in today's video. So Goldman Sachs and JP Morgan both believe stocks will rally if inflation data is soft. This is going to be a very big event. Generally speaking, when we talk about inflation numbers, you're usually looking at a decline followed by a spike and then further declines. That is, if the Federal Reserve is doing their job. It's not all the way down. The question is going to be, when do we see the slight spike? Is it this month? Is it because of energy prices coming through in that shock that we saw only a month ago? Well, this is the question, and this is, of course, the game plan that JP Morgan's put together. I shared this over on our Twitter. If you're interested in following at FX Evolution, links in the description down below with the link tree. Let's move over here to what they believe is going to happen. Of course, probabilities are important. Most people believe it's going to be stuck between 5% and 5.5% in terms of CPI. And this will usually mean a big change in markets. If it comes in a little bit hotter than expected, let's say 5.3 to 5.5, JP Morgan believe the market is going to tank and basically move back into demand levels we'll talk about later on when we look at the S&P 500. If it comes in on expectation, they believe the markets will go up and break this tight range. So which one will it be? Well, let's start to talk about some of the things going on in the markets as we bleed into some chess style scenarios. First up, we need an update on what's going on with central bank liquidity. As I've mentioned, we've got the US here and kind of like an aggregate number on this purple line. And we've seen in recent weeks, especially since the banks, the other regional banks started getting tightening, the reverse repo market has had some action. So while the Fed's saying on one hand, oh, we're not doing anything, don't worry, guys, they are certainly supporting the market. That led to, of course, a bit of a dead cat bounce potentially in this distribution, and we've gone back up. We, of course, had that snap, those hedges coming off as well from the most hedged event, which was the FOMC last week. And it didn't really represent anything in particular. We saw a sell and then we saw, of course, a buy. Let's move over to VIX 1 days. This is the VIX chart that we probably need to start looking at nowadays. We know that everything changed thanks to zero DTEs. So we expect, of course, volatility to spike into an event such as this. You can see it did spike. And if the number is not what the market expects, I would expect VIX 1Ds to actually go up. And of course, if we see fear coming into the markets, which generally is what the VIX is seen as, that usually means the downside is coming. You can clearly see here, though, the ramp is nowhere near as much as it has been in the last. All of these numbers here are either CPIs or FOMC events. So clearly the market is not freaked out as much as it needs to. It's become complacent over the last couple of months. Now, I've seen some comments down below and people are saying, where is the updated FOMC dot plot? We will get one soon, but of course we won't get it just yet. I've just loaded up here the latest one, which we of course have from March, which shows that the Fed was basically saying we are going to stick to the plan of holding rates for 2023 and cutting them a little bit in 2024. This is probably the most important thing for investors and middle-term swingers over the next 3 to 9 months because it's a complete opposite to what the market is pricing in. This is the chart of what the market is doing. You can see it's all about cuts coming through September of this year into October, into December. I still don't think the market's got it right here. I think 75 basis points worth of cuts is too many. But what do you think in the comments down below? I will load a few of those comments tomorrow when we discuss it a little bit in more detail. So stick around for that show. But yeah, it's very important to note that the market is really expecting drastic cuts. On average, once the Fed has hit its terminal rate, which is the highest rate it's going to go to, very arguable they've just done that, they tend to hold it for 6 months. Okay, so 4 to 6 months is usually the average through there. On some other concerning notes, we've just hit a new all-time record for the top 2 stocks from 1980 all the way over to 2023. We've never seen such saturation of companies being the leaders of the stock market. 14% of the S&P 500 is now 2 stocks. And guess what they are? Well, of course, it's Apple and Microsoft. Well, yes, they're great stocks, Microsoft being my favorite stock in the market. But geez, I tell you what, they are a huge part now. And if they start to fall off when we look at the resistances being formed, things could get a little nasty for the S&P pretty quickly. Let's also talk about lost decades. I just want to bring this up because there are different ways to invest in lost decades. Now, it's very arguable that we could be going into a slower time for the S&P 500 moving forward. We've just seen an incredible bull run of some of the biggest stocks in the world. We're obviously seeing that right now. But pretty much the US has always had these types of cyclical events. They've had points where the S&P 500 hasn't done so well. Small caps have done very well. Then points where large caps have done very well. Small caps have done very poorly. And these areas often coincide with what we call the lost decade. There's a good chance that sometime later on, after all of this stuff kind of blows over, that actually small caps may outperform large caps. And I believe a lot of that's got to do with innovation coming from AI. Think about how fast and nimble some companies are. Let's go with Adobe for a question. Now, Adobe is, of course, enriching their product at the moment with AI software. What if, though, for example, there were other people taking advantage of some of these open source AI programs and they were able to perform or create a very similar, more like cheaper, cost-effective, nimble kind of business? Maybe we're already starting to see that with DaVinci versus Premiere in the video side. So, of course, this is going to be where the battlefield is. It's going to be AI, and I do believe that innovation is going to come out of here. So, interesting to start looking at small caps, I believe, in the future as well, if you're an investor. And I know we have a lot of investors that follow this channel. What do you think? Comments down below. Let's go through it soon. Now, Chinese tech stocks, are they doing well? The answer is no. The question is, are they value at this stage? Yes, I did say it was going to be a tech area that you might not have considered recently, but I have seen in the comment section people talking about Baba and other tech stocks. Well, here are some of the switches we've got here. Big bullish momentum switches coming from the reopening, coming from the stimulus, but that has totally soured in recent months. It's gone all the way back down. And when we see these reads, which we have quite a few reads actually over time, take a look at some of these stats. Now, if I was showing you these stats for the S&P 500, you'd be horrified. 45% of the time, the market is up by the end of seeing a stat like this over 12 months. Look at the average. 10.8% down is the average. Max loss, 21.7%. So this is not good. And we've seen this happen a few times in China. And obviously, it's not the kind of thing that you'd want to be necessarily going out and saying, oh, well, look at the bargain. With deglobalization, you can really see it coming through here. A lot of big players are moving into India and other markets. And again, the stats are just brutal. 33% of the time, the market will be bullish. Generally, it's down over 17% over this period. Now, that doesn't mean we just go sell it, but it just is a cautionary tale in terms of what we're seeing on the data. Let's move over here to smart money versus dumb money. I haven't really updated this chart. It's pretty much the same though. It's from a day ago. They're sitting flatlining on each other. No one really has any idea whether we should be breaching to the upside or the downside. And that's because there's a compelling argument for both ends. And we'll talk about it a little bit later on. For investors, I just want to always reiterate, one of my favorite indicators is forward PE. I will get an update on this after earnings season, which obviously we're still going through right now. And we're still trading well above the 16.8. We're about 18 point something at this stage. So it's not really cheap to be necessarily looking at the market at this point. What about hedge fund managers? What about the biggest players in the game? What are they doing? They are still positioned neutral at this stage. They haven't really gone all in on the market, which usually is coming up with the 600 to 800,000. That's when you kind of say, well, they're undeniably buying pretty heavy positions. And they were very negative all the way through the middle of 21, all the way till pretty much October of last year. And they started getting neutral on the market, and we find ourselves here. And that's the problem. Everyone's neutral. Everyone's questioning everything about this market. And that's why it's basically just the QE stocks that are doing well. So when we see those central bank numbers going up, which we have seen, which is liquidity in the back end, people are just going to, what's the game plan? Buy top 10 tech stocks. That's all they're doing. They're just like, top 10 tech stocks, let's buy those. We'll sit there and we'll figure out what happens. They're kind of defensive anyway. Let's move over to sector rotation. It was a day of nothingness. You can see there was still some moves through the rotationals, but no big news coming through there. We'll go to the 5-day here, and it's a little bit different story. Obviously, we still have weakness in the regional banks, though that did get squeezed through last Friday, as we talked about. And I'm not sure if I'd really... The first couple of days of squeeze were excellent, but usually it's short-lived. So you've got to be a bit careful with the squeeze play. I think a lot of people are getting on board that. I wouldn't be surprised if the market does a bit of punishment there. So be careful if you're trying to squeeze KRE out. GDX doing the best, which is gold. It has become the prominent sector of rotation over the last 3 months. We'll do a special on that along with our rotational concepts moving forward. So make sure to stick around, subscribe if you're interested. Let's move into the charts now. We'll start off with RSP. This is the equal weighted S&P 500, and it shows us that the market is not so healthy. Obviously, we know breadth is well down, and we haven't got breakouts either way. So we have no signal, bearish or bullish. If you were guessing here, you would obviously be pulling the fibs, which we did. 61.8 on this particular high to low scenario is where the fib is. And we made a new low on RSP, but we know inflation numbers can completely blow these out. Let's move through some other things. Copper. Are we going to hit a double bottom and then rally? Or is this going to finally get through 3.8 into 3.7, which will be the next move? And if we go under 3.7, well, the markets will be in trouble. We know Dr. Copper is super important. Demand destruction. This is what it's showing us, and we will be following it very closely over the next 24 hours. Let's move over to junk bonds. No information here. The most boring session ever for junk bonds. Look at that little sitting in the middle of nowhere land. So will it break down or up? We don't know yet, and that's okay. We'll keep going through. Treasuries are going to come under some further pressure. I think we've seen the price action we need to see. It's most likely going back down to 100 in anticipation of things like, well, it's actually two things I think that are occurring. Number one is, of course, the debt ceiling issue. That will be sorted, but it will be protracted and annoying, and it does hurt some treasuries and potentially offer opportunities for people if they're risk takers in the treasury field. And the other thing that I think is happening here is that the market is starting to say, well, maybe the Fed won't cut as much and yields are coming up a little bit. Now, because yields are coming up a little bit on the forward horizon, that's going to put pressure on treasuries a little bit, on the US 10-year, 20-year, etc. And then what's going to go is that we might see a decline into, of course, movement through. Remember, you're looking for the US 10-year to make underneath, I think it's 3.32 or whatever it was, to basically make treasuries, great again. And it's 3.3 flat pretty much. We need it under there. If it gets underneath there, that should really rally treasuries quite a lot. Dollar index, let's take a look at this one in the middle of its own accumulation or distribution. Weeklies would have you guessing that it is a distribution into a short based on the closure here is not very good. You get a lot of wicks that, of course, have come off. We have an outside and a long leg doji, so we don't actually have direction yet. And that's the thing that's a bit frustrating. Though it did hit one of our targets. If you were like kind of long based on this entry here, which is an excellent entry, don't get me wrong, this would have been my first target. So I think this target, maybe even the total target based on the CPI number just being too scary from each way being very, very real. And we just don't know which way it's going to go yet. Daily doesn't give us too much. We have some closures above these levels, but you could make a case here. You could make a case here. I don't think we have edge. And as I say, patience, react, don't predict is one of the key things. You'd have to go with downtrend is still the trend. If we move over to the euro here quickly, just to see, The euro came into the demand and it's finding some buyers. Not enough yet. It did break through that long-standing trend line. But as I say, selling a dulling market is difficult. So I'm not sure whether that was the best move. And I think a lot of people have jumped on the sell train. You've got to be very, very careful. Gold's been a little bit simpler. It moved up into the box that we were talking about in the previous video. This is where gold should theoretically find weakness. And if that all of this whole setup is correct, then this is actually the place that you should see sells come through. Like any trade, it's ratio based. It's like, have you seen this before? Can you replicate it? Is it like a business? That's the way you've got to kind of look at trades. But I do think it presents an interesting concept of seeing whether the CPI can push it down. What's going to force gold down? It's most likely higher CPI, which pushes yields up. And unless people think it's super stagflationary, because that's, gold does do well during stagflation, which is the hard thing. Generally, when yields go up, gold will usually drop off. And we've seen that play a lot. I've explained it a few times. Heavily traded zone still remains really around 1983. So that would be an interesting level to see the market drop. But I do expect gold to do a lot of flicking around. So it could easily do like this. And then kind of, we'd probably see like that. Would be one scenario. Another scenario is it comes down quickly, grabs into this area, which we know has been fairly traded, and then rallies off. I think it's more of a patience react in this case for gold. Move over to oil. Oil could spike into our zone. However, I do feel bearish about it in this red box. And it hasn't quite entered the red box, but we've now got some interesting data coming through. So if we take a look at the data here, you can see here's the beautiful block. That block was respected over the last 24 hours. Very nice demand. So we know that's strong demand. And we get a little bit of an inkling that if it wants to change, so if we go 15 minutes, let's say we're a little bit, I still think it'll come back up a little bit more, but let's just say it did breach down here. So we can put in a box there. We've got the low, so we know that's where the demand is. We know that's a high. We know that's currently just a low. We know that this has just made a higher high marginally. So if it now takes that level, I would think that rally would be met by sell demand. So just be very, very careful about here. At the moment, this is bullish. So it's bullish because it came off this block here. You can see the importance of this area, why it's so big a deal through this whole rally. And I'm looking for it ideally to come in, have issues in here, do something like this, and then look for it to continue the trend down. We'll be watching oil very closely. Let's move over to XLE, which is, of course, oil, the sector of stocks. Still looks pretty weak. Nothing much going on here. You could make a case that it's tried to island reversal back up after its initial one. You could also make a case, look at this, gap up. What if the inflation numbers come in bad and it gaps down? Well, it's probably going to 76, maybe even lower for energy. So I still remain pretty negative and thinking of demand destruction, but that's a medium-term view. So you've got to let 3 to 4 months play out in that case. Generally, it may happen before, but when you have that view, it's all about timing. Timing and instrument selection is very important. Tesla did drop through the session. It then made a bit of a recovery. On the surface of it, if we look at the daily here, we still have to, you could again go with, well, what about this being a bit of a turn event? We saw it come out of the gates fairly strongly. Of course, it went towards that idea of 176, 180 being a gap fill. And I guess I'd still stick with that plan. Overall, medium term, I'm still negative on it towards 145. But the short term, if I was day trading, if I had to be in it, if I had to make decisions, I guess it would be the buy side at this stage based on what we have. Now, NVIDIA is an interesting one. It rejected above this high box. So I said in the previous video that maybe we'll go to 300 for NVIDIA before it falls over. There are so many tech stocks that are at their peaks or very close to their critical peaks. We'll just show all of them now. So first up, it's NVIDIA. You can see here a little bit of a rejection, not enough to say the trend has changed. The trend has absolutely not changed. You can tell that when you look at a chart like this. I do think it'll come down. I do think there'll be a switch. We just haven't seen it yet, but we'll keep updating. Let's move over now. Google. Here's one that actually had a breakout in the previous session. So look at this. It broke out and then it rejected. And is this the inkling that we need to look at when we're considering that the markets are actually trapping people? Look at this. So this is a shooting star, obviously, or a pin bar rejection. And it's come off a very nice theoretical breakout, which we talked about. It was a great rally for most of the session until the end. And then it came back down like this. Now, if we snap that with the daily close, we should squeeze. And I think this is the important factor of Google. I'm really interested in this chart. I'll be watching this one because if this is a false break, which it looks like at the moment, then we take a new low. Well, what's it going to do? There's people trapped here in buys. They're going to get squeezed out the low end. Patience, I think, will pay here. But yeah, very interesting chart here for Google. Certainly one I'm on the watch. Let's move over to Apple. Apple's in that resistance zone. I'm, kind of thinking this could be possible. I still said the other day that I believe that if you're a big fund, you would be scaling back a portion here. I still stick with that. I think it's a dangerous zone. It's one of those areas where we've seen Apple fail so many times during these rallies. So although this trend line got snapped off, this is the August rally. It's hard to believe Apple was up here this high. I mean, this stock is just, it almost absolutely defies beneath because it dropped 30% after that. That's a significant drop. And again, if it went back down to where it was, it would be 30%. Huge rallies. Not the same as it was here where it was just gapping and gapping and gapping. I mean, this was one of the most unusual runs we've ever seen. This was the most unusual run I've seen. I remember that. It was ridiculous amount of days in a row, just super bullish. So these are symptomatic generally of false runs. This one here is still very aggressive, but it is nowhere near the aggression of these two. These were easier to say, okay, that's just stupid. This one over here, because of this area and also even the swings, it kind of looks like just a normal growth curve for Apple. And I know that doesn't seem normal when you look at it, but if you go back through history, it's been known to do these types of things, take out about 50% of it and then keep going. So I still think big resistance here across the stocks. Microsoft, my favorite stock in the market. It's undeniable it is at the key level. We saw the earnings, boom, straight into the next key level. Fantastic. Very happy with that. But it's still a big problem zone. And if we drew a huge fib, so if we put a huge fib on Microsoft, you'll see it's above the pocket, but it's still in that last little kind of holdy zone, which is 75, 78.6. And this is a huge supply for it. So if it's going to falter, it falters here. DAX, move over to the German index here before we do the US. Again, could it be a UTAD here, which is we already had a break up, we got a new break, then we find weakness. We don't know. Weekly looks very bullish. Very, very tough. Very tough. I'm telling you, it's difficult because you would think super bullish. But if the markets were able to then close below these wicks, I would think we're actually on a swing short play at that point, and we can actually say, okay, well, we should sustain a bit of shorts here for a period of time, which would be nice just to get some direction outside of this chop. It's been better to play sectors and individual stocks over the last pretty much month or 2 months. Let's move over to the XJO. XJO is weak, in my opinion. Obviously, copper will dictate this a lot, but it's back to the 61.8. I think this is where the Australian market could weaken. CPI numbers will be interesting. IWM Russell, this is one of the most important. It's setting up for anything. We have a gap down and gap up, which is usually an island reversal, which gives you, of course, thrust. It's in the right zone as well for generally quite large buying. Then we have it sitting like this. Do we get a gap down and then create a separate island reversal? Remember, island reversal is about 58% kind of pattern. So they're pretty good. As patterns go, a lot of them aren't very solid. I think island reversal is one of my favorites out there in the markets. They do show a momentum shift, which is why you often get slingshot style trades from it. But in this case, yeah, it's setting up right in the middle, and all the markets are like this. If we go over here to the Russell 2000, is this going to be the first initial reaction? Market moves into the short zone, finds weakness here. We know there's big traders here. It's one of the most traded zones. So this will be where you would think the bears could bust, and it will come in play when we think about one of the scenarios here for the S&P 500. The initial reaction is often the wrong reaction on these news, so it often goes boom, boom, unless it's clear cut. So if the number's kind of middling, let's say middling worse, and it goes off in one direction that doesn't quite make sense to you, maybe question it. If you then see a reversal, well, you'll know what's happened. The trap has been set, and it's very hard to have this patience. If I was to say to everybody out there what's the most important aspect of every best trader, best investor I've ever seen, it's got to be temperament. Temperament is the word of every single great trader. Where bears win under 1700 will be a huge deal. We're not even close to that just yet. Qs, new high, rejected again. Are we coiling for a breakout, moving towards 328? Well, we should be very damn close to getting some kind of action here. Or is this a false break, pulling in the final bulls? Volume's down. We know we've had basically no trade. We just don't know whether this is a UT or a UTAD as a Wyckoff distribution, or whether this is just a dulling market that we shouldn't short and it's going up. Instrument selection is very important here. I know it sucks to say, well, you don't know. It is a absolute gamble, some of this stuff right now, unless you have the correct instrument to be able to survive and weather the storm. Let's say you're medium short, bearish or whatever. If you have like a 3-month put, well, it's not going to matter too much. But if you have a 1-week put, well, you're going to be sitting there sweating before this CPI number. US 100, you can see the futures here. Small shift if we actually close underneath this zone. High, low, higher, high. Lower low could bring in some sells. No real huge shift though. I think the big tell will be underneath this weekly close. So we go boom, 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 and then probably short. That's one scenario I'm playing at. The other scenario is obviously just to go long straight away. And then if we get a daily close out, well, we move towards 13.6 in my opinion. Let's move over to the S&P, sitting on the daily 20 moving average. So right on mean reversion. We've got the island reversal concept, which is the gap low, gap up, which usually brings in bulls. And then you also have the false break concept. So problem is it makes it difficult to pick the direction. Central bank liquidities remained flat the last couple of days. Again, it was injecting more. It's still, and I think we need to remember this, it's still underneath where it was. So if we know that it's more of this middling ground, it probably points towards 4K being actually more fair value to the market right now. So we went and took this number out here a little bit and we think about it. The market basically should be pricing around 4,000 to be more fair value to CB liquidity, and it certainly is not at this stage. So that is a +1 tick for the bears that even though it injected, we're still seeing it start to taper back off, which is good. Let's look at the US 500. Here's the daily, the bear zone of bears, of course, we talked about. We see some weakness coming off that, but negligible really. 2 hour, if we go down, we just don't have anything. We have nothing to go off here, which is kind of crappy. I'll give you some scenarios. Scenario 1, I think, is the market kind of drops down into the 40.80, 40.70 as the first move. And then we actually see buyers off that zone to then push a squeeze liquidity up. Now, that will obviously be more of a middling number that I think does that. Take a look at JP Morgan's chart as well that might occur. The other scenario is we take this high and then we initially reject. So if we took the high first, I'd usually wait for the daily close. That would then solidify, whether we're actually bearish and the false move is there or not, because this could easily happen. We go back, fill 41.67, then we drop down, then we breach underneath these lows here, which we know is demand, and then we rally, and then I would look towards the short. So I like to play chess with the market. I like to have usually 4 scenarios or 3 to 4 scenarios so that if it plays that and you can see the trap, that's when you're going to have the bigger edge in the markets. And I think that's very important to always aspect. So there's one where it goes down first, finds these kind of buyers around that 40.70 to 40.80 on the S&P, then rallies through. The other one is, and this is all with middling numbers, the next one is that we see a rally early, push up maybe into this supply, 41.67 gap fill. If we then sell off later, you'll know that's trap liquidity, and then any rallies probably would be looking to be faded from a technical perspective. If it just rallies and then closes the daily bullish, then we probably move towards 42.20. If we clear 42.20, 4300, 4350 become real. I'm super keen to know what happens. I would love to see this number. I kind of just want to click a button, just go forward 16 hours, though probably wasting time is not the best thing in the world. And then, just see the number. I'm super interested to see how it comes out. Let's have a look at options positioning into the event. So we'll load up here with SPY, and what we'll do is we'll load the 10th. So you can see there's a lot of puts at 408, not an incredible amount, but the kind of strike is here towards 420 being the call in, 417, and of course the put in 408. So not much move on the downside there. If we move forward to, I think it is the 12th, just let me check here. Yep, 12th. The 12th has 400 as being the put kind of wall area, and then 422, 416. So again, that lines up with where we think that top end could be from an options perspective, and the bottom end probably sitting around 400, which makes a lot of sense as well, with 410, which is where it is right now, being the kind of catalyst. I would say one of these is more likely this week, based on just like CPI finally getting us towards one of those extreme zones. Let's move over here to Bitcoin. Nothing yet. So we know that it could be a head and shoulders reversal. We've already plotted that out to a demand. It's super at demand right now. If buyers are going to recommence, they're here. It's all happening ahead of CPI, and we know CPI pushes this number. I would give Bitcoin again an 8 out of 10 rating recently for being incredibly technical and really great. I've enjoyed this area very much. It's been one of the best times I've seen for Bitcoin in recent months, and I still think it's sitting on nice technicals. I mean, you've got great demand here. You can make a super bull case for it. But my first scenario would be if the inflation number, let's say the first result for Bitcoin is down low, then it comes up and it snaps that kind of high. I'd be looking at probably the buy end. If it goes high first, comes up to something in here, maybe this supply, and then starts shorting off, and then takes that low as well, of course, you're looking at pretty much just shorts. Anything under 26.6, if it is able to close below there, I would say that's moving towards 25, 24 for Bitcoin. So another interesting chart. Looking forward to doing the update for you guys tomorrow. CPI, core inflation. I will have an earlier video out as well, so don't worry about that. You'll be updated as soon as the market closes tomorrow here on the channel. Inflation expected to come in at 5 because why do we need to update? Because then we get into PPI as well. So PPI, we get the numbers there, and then we have prelim UOM consumer sentiment as well at 10 a.m. here in the US. Thanks so much for watching, guys. If you enjoyed today's video, please remember to subscribe, smash that like button, follow us on the socials, specifically the Twitter if you're interested, and of course, 3 free trading cheat sheets if you're interested. Bye for now.